Welcome back again to Tim Bigham's Options and Volatility newsletter. We'll be taking a look today at a series of potential different trades on Golden Ocean Group, GOLG, where some big time repeat call buying on kind of an unknown name sets up ideally with several trades to follow the flow, capture the vol, lean bullishly, and depending on which way you want to play it, we have an assortment for you. So let's jump in and take a look, shall we? First of all, here is the chart on GOLG. You can see the stock has leveled off pretty much here. It is post earnings. Earnings did come out on February 26th. So we'll actually do a couple of comparisons, take a look at the recent big time repeat option buying. Also compare GOLG to February 20th, where it closed at 970, the exact price that it closed at on Friday. So certainly an easy comparative from a week and a half ago. So let's jump in and take a look at things on the GL front. First of all, here is the unusual option activity screener. One of them I use, right? Coming out on February 27th. You can see 27,900 or so options traded, almost 28,000 versus less than 1,000 on average volume for GOLG. You can see implied volatility at the highest it's been in the past year. The big jump in IV of almost 30 vol points sets up ideally for that vol capture trade. So we can take a look here. Here is the day of that big volume. You can see IV spiked to by far the highest level over the past year. And this is post earnings, right? Here was pre earnings on February 25th. 26, earnings came out. Normally you get a vol crush. Here you get a huge vol pump. The stock, as we saw, didn't move too much, right, on the earnings news. So certainly this big repeat call buying, the reason for this vol pop, you can see how from the previous day to February 27th, the IV moved across the term structure vol, but especially in the short term, moving from 50 to the mid 60s. Then we can take a look at it from a different perspective. Here it is going back further in time, the at the money generalized IV. You can see a little over 2 weeks ago or so, IV trading in the mid 30 range. And as far as following that huge call buyer we saw out there, right, jumped all the way to 64. We can then take a look at the different expirations, right? The majority in the shortest term, the May 21st expiration traditional options. April saw some unusual call activity as well. But you can see the volume, 17,000 in the Marches, 9,000 in the Aprils. The following day, we did see IV just creep up a little bit more here, right? Not too much. Basically, finally starting to level out here. We can see that IV did just pop up a little, but that's what we like to see before we jump in, right? We like to see kind of that buying start to lessen, right? The volume still fairly heavy, but much less, right, than that previous day's 17,000 and almost 10,000. Here we're seeing just 6,000 and under 5,000. So volume starting to wane, right? IV pops starting to certainly lessen, pretty much leveling off. We can take a look too at a IV in a different form, right? Here it is on basically a 30 date expiration, slightly out of the money, 30 to call. You can see pretty well trading around that kind of mid 30 to maybe 40 range. Then when we saw that big repeat call buying come in, you can see this huge spike in implied volatility. So that's set up ideally for several vol capture trades. So walking through that kind of IV in March, you can see here's the day before that big call buyer, right? Open interest less than 1,000 on the slightly out of the money March 10 call. Stock was at 940. 15 contracts, no big deal there. The 27th, here's the day of that big volume, saw 21,000, right, of these March 10 calls trade, right, which just dwarfed that open interest, as we said, of less than 1,000. Did see just a little bit of volume out in June as well, but not too much. Then the 28th, we saw even more volume in the Marches, right? We can see open interest now has increased dramatically because of that big repeat call buying on that. And then finally saw even more volume coming on March, but we're seeing IV level off around that 70 level. Open interest now over 30,000 on these options. So certainly some big repeat call buying, to say the least. Big jump in implied volatility. Basically closed right around 70 after the 3 days of call buying. Started off under 40, so set up ideally for a couple trades here. Went back to the day, and this is 1 day delayed with it, simply comes out the following day. So February 20th, when the stock closed exactly where it did Friday at $9.70. This is before that big repeat call buying we saw, which was post earnings, right? We see the March 10 calls trading at about 30 cents midpoint, just under a 40 IV here. So the covered call trade, right, which is simply going out, buying the stock, selling that covered call, would have cost about $9.40, right? Buy the stock at $9.70, sell that call at 30 cents, IV at about 40. Then let's jump forward to Friday's close, right? We see, as we said, the IV jumping to 70, right? That covered call with the stock exactly at the same price has gotten cheaper by 20 cents. Why? Because the call that we're selling went up in price from basically 30 cents to 50 cents, right? We were able to get 20 cents more for the covered call, right? Stock exactly at the same price. So buying the stock, selling the call actually made the trade cheaper. We did have over a week of time decay as well, right? And certainly that should factor into it too. Roughly going to have about 2 cents a day in time decay. So these calls should have gotten cheaper from a time decay perspective, right? But they actually got much more expensive. Why? Because of that big repeat call buying that we just showed up. So certainly anyone to simply want to follow that unusual call activity and capture that big vol pop, right? So lean bullishly with that repeat call buying, but capture the fact they're overpaying for the calls, buying the stock, selling these very comparatively expensive covered calls makes a lot of sense. The trade has gotten cheaper with the stock going nowhere over the past little over a week time frame. Certainly it should have gotten a little bit more expensive simply because of the time decay out there. So that's a simple way to do it. And anyone who basically trade options at all can do a covered call trade. It's the lowest level of option approval. Cost of the trade, if you do it 100 shares and sell one of the calls, you're looking at putting out $940 a net on the trade or so from going back a week and change in time. But on Friday, it only would have cost $920. So the trade got cheaper when it should have gotten a little bit more expensive because of time decay. Then for those who like to capture vol as far as doing it in a manner where you capture both sides of the markets, the puts went up in price the same as the calls due to put call parity. We can take a look at the straddle. Here's the straddle price that a little over a week ago at February 20th, right? The at the money March 10 straddle stock at 970 again. Calls trading at 30 cents. Puts basically I put in 65 cents, right? 60 cents range, give or take, simply because puts are 30 cents in the money. The calls are trading at 30 cents. So the put should be priced about 60 cents, add in a little bit of time premium. So I assume the put's about 65 cents, which gives that straddle trading for just under $1. Then fast forward to after all that call buying, right? We can see that the puts actually went up in price. The calls went up in price both, right? That straddle now trading for $1.40. You can sell the puts at 90 cents, the calls at 50 cents. Before that big call buying, as we said, the puts probably about 65 cents, the calls at 30 cents, trading at, under a 40 IV. After that big call buying, repeat call buying, IV, as you can see on both the puts and calls, now well over 70. And then another way to play it, simply because IV lifted across the whole term structure of volatility, is a calendar spread trade, right? Which is simply going out to the June 10 calls, buying those, and selling the comparatively expensive March 10 calls, to capture that big term structure vol differential. So the Junes did go up in price, certainly, right, but not nearly as much as the Marches. So we can lean bullishly, hope for a close somewhere around 10 come March expiration would be ideal. The other thing is, remember that that huge amount of call buyers will have to, in essence, get out of that trade at some point if they want to take a profit, right? That will reverse the sort of huge lift in IV we saw going into the trade. When they go to get out of them, right, they're going to have to depress it. So we can, in essence, play the fact that they're willing and have to overpay to get in, and they're willing and have to undersell to get out. So we can take a look on Feb 20th with the stock at 970, that calendar spread trade, buying the June 10 calls, selling the March 10 calls. Would have cost a little bit over 30 cents, right? IV, you've been basically buying and selling just under a 40 IV. Fast forward then to Friday's close. You can see IV on those Junes did move up from under 40 to just over 40, moved up a little bit over 6 vol points, but these Marches exploded, almost doubled from an IV perspective. So that trade, even with the stock going nowhere and time decay should work in the favor of this trade structure, that trade got a little bit cheaper. So instead of having to pay just over 30 cents to get in, you can get in under 30 cents or about $30 for each calendar that you want to buy. Plus, you have those Aprils and then the Mays to continue to re-hedge if you need to bring in more premium if the stock doesn't move towards that ideal 10 spot. So this trade I like very much as well. Certainly define risk. Anyone approved for spread trading can do this very cheap trade. So we run the gamut here to capture that big pop in implied volatility. Simple buy right trade, right? Buying the stock, selling these very expensive March 10 calls, right? That is for anyone who basically can trade options as approved for options, the most basic option trade. For those who like to sell premium and capture that IV lift on both sides, right? Selling that March 10 straddle, which was trading under a buck, trading for almost a buck and a half now with the stock going nowhere and over a week of time decay coming out. That makes sense for those people. And then those who can do spread trades and want to keep more of a defined risk, a low cost sort of scenario, doing the calendar, going out to buy the June 10 calls, selling these very expensive Marches, right? Again, pretty flat term structure of vol before that big call buying. Now a huge term structure vol edge of 28 points or so. That calendar spread trade has gotten cheaper when it should have gotten more expensive. So for those who are considering any of these trades, certainly, any of them make sense here to capture that big repeat call buying post earnings again, more importantly, in GOGL. So until next time, as always, here's the good trading. Take care.